Hi, this is Drew Tignanelli. This is a market update, January 27th, 2010. As we said in our market commentary at the beginning of the year, which you should have received, we said this was going to be an unusual year. We said that we're not sure what we're going into in 2010. We can point to many very bullish signs. There's some good things going on that would give us indication that this could be an incredible opportunity year still. But there's just as many signs that this could be an incredibly negative year. And a misstep could easily trigger off some panic selling of some sort that we'd want to stay way clear of. At this point in time, our indicators are telling us that this market is not going back to the 2008 scenario where you had systemic risk. Systemic risk is where the whole economic system could literally just collapse. Now, I've read many things about this, what happened in 2008, and literally Geithner and Paulson and Bernanke were extremely concerned that the economic system was going to just totally shut down, that when you went to the store to get groceries with your credit card, even though your credit was perfect, even though you paid every bill, your credit card wouldn't have worked. You tried to write a check, your check wouldn't have worked. You went to the ATM machine to try to draw out money, it wouldn't have worked. It would have been that type of scenario. When one or two or three banks go under, the FDIC can step in and clean those up, and by Monday morning you don't even know that your bank went under. But if you had a systemic risk like what was ready to happen in 2008, where you could have literally had a shutdown of many banks in the entire world, it would have taken weeks, months, maybe even a year to figure out how to sort that thing out. And it wouldn't have been a very pretty picture. Today, those signs are not here. There's no economic panic going on in the credit markets. They're acting normally. People are able to go in and borrow money in the stock market. They're able to sell stock in the market. They're able to borrow money in the bond market. They're able to borrow money from banks, though it's not right now. Banks are definitely much more stringent than they've been in the past, but they're able to borrow money from the banks. Therefore, where's our standpoint? Our standpoint right now is you have 1 foot in, 1 foot out, and what foot you do have in equities has to be high quality, income-oriented investments where you're looking for that income to assure that you're probably going to make some rate of return. And you're not trying to make a lot of money in the market. You're just looking to make a good, conservative rate of return. That's our focus. Even in our Asia investments, we're looking for the same thing. Income and growth, high-quality investments. But with Asia, we have a very different picture. We have a picture of governments that have done a lot of the good economic things they need to do. Budgets under control. Lots of accumulated money. China alone has $2.6 trillion of cash accumulated now. Now, compare that to just a year and a half ago, they had $2 trillion. They've just grown by another $600 billion of cash. Their people are not heavily indebted. In America, it's not uncommon to meet people making a good income who have more credit card debt than they have liquid assets. It's not uncommon in America to find somebody who owns a house that's worth 20 or 30% less than what they have in mortgage on it. That's not true in Asia. You don't see hardly any of that in Asia. But the Asian markets have corrected a lot more in the last 2 or 3 weeks than the U.S. market. Asia's down about 8 to 10%, and the U.S. is only down about 5%. But then again, keep in mind that last year Asia went up about 75% and the U.S. went up about 20%. So, you expect the Asian markets to be a little more volatile. So our focus, again, is high-quality investments, good dividends. Watch the investment markets very closely. Watch the signs that give any indication that there's any problems arising. One economic thing we're watching is there are a lot of people that are concerned that you're going to have a default of a country sometime in the not too distant future, be it Greece or Spain or Portugal or Hungary. One of the Lithuanian countries, Latvia, Lithuania, there's a potential default like that. Could cause some ripple effect, but I don't think it will cause systemic risk. So anyway, our point here is, again, it's a schizophrenic market. There are a lot of good signs and there are a lot of bad signs. High quality investments, look for income, and focus a lot on Asia and wait for the next opportunity. In your 401ks, do the same thing. 50% toward the safest you can find, cash, bonds, and then the other 50%, if you want to keep it into equity invested, choose good international and U.S. Solid income and growth-oriented investments. If you really want to be conservative in your 401k, I'd go about 75% in bonds, type cash in bonds investments, and only 25% toward equity. If you have any questions, you want us to look at your 401k, feel free to send it to us. If you have any personal financial planning questions, feel free to call us. We're here to answer them for you. Our mission, remember, is to help lessen the worry and burden of money management. And so we want you to realize that we're looking at this, we're monitoring it, we're aggressively making sure that we are confident about why we own what we own. There's no guarantee that it'll accomplish what we hope to accomplish, but we're watching it every single day. And you go ahead and enjoy life, and we'll be here for you as you need us. This is Drew Tignanelli saying God bless.